Babber A, what are your thoughts on MPI account? Good question. So I've discussed this in at least one of my other Wealth Care Wednesday live streams, which you can find, and you might be able to find some more information than what I go over now, but I'll try and cover it. The concept I like. I like the concept of it. The MPI account, basically what it does is it sets up an IUL, and it sets it up at a much higher level than what you would typically want to fund it at. And the idea is you're going to fund it at, let's say, $20,000 a year you want to fund it at. They may set the policy up at $60,000 a year that you could put into it. So you put $20,000 into it, you pay that for a couple of years, and then you can borrow out of it and put that money right back into it as new premiums in order to max out up to that $60,000. And I'm not too keen on how they advertise this MPI account because they're way too optimistic on the returns that it's going to provide. And the way that they pitch it to everybody, from what I've seen, with no caveats, they basically say you can make 12 to 15% conservatively. And I think that that's a bunch of crap. I think it's possible. I think it's definitely possible. You could possibly even make more than that on any given year. Are you going to be able to average that much? I don't know. It's going to depend on the stock market. It's going to depend on the indexes that you're tied to. It's going to require that you fund it how you're anticipating funding it. And it's also, and this is the big thing, it's going to require the cap rates or the participation rates that the insurance company starts off giving you. It's going to require those to stay high enough that you can earn those types of returns. So that's a lot of ifs that need to happen. Those are a lot of things that need to continue happening. And as we're seeing over the last 10 years, those cap rates have been coming down as insurance companies have been struggling to make good returns. So I think MPI and their whole approach to this totally ignores that possibility. I argued with Curtis on his channel about it. I said, look, you're not being very realistic here when you talk about this being a conservative amount. And he points back to the historical average of how these indexes perform as proof that his concept will work how he says it will work. But what he ignores is that none of those historical averages account for the insurance companies reducing those caps or reducing the participation rates. And that's where you can really get into trouble. So you got to watch out for that. Like I said, I like the concept because I love using leverage, and I do that in my policies. I pull money out and I put it back in as new premiums if I need to. That might be the best use of my money at the time because I may have other money tied up in the stock market. So I try not to have, when my premium rolls around, when my anniversary rolls around in my policy, one of my policies I pay $50,000 a year on. I don't just sit around with $50,000 a year in my checking or savings account. I put that money to work. So the number one place that I want to pull that money out of to put it back in and make that payment is one of my other policies that I have some cash value available in. That way I can keep my money working for me in other places that I have it working. So I love the concept. I'm on board with the concept. You just have to be realistic with the people that you're trying to sell these to. And I think that's where they fail. I'm happy to give you another perspective. Like I said, I think it's good. I think I design a better policy than they do. So if you're interested in something like that, check with me because there's nothing special about what they're doing. There's nothing special. They make it sound like there's a proprietary loan program or there's a proprietary, there's this match that gets happening. It's the MPI match. There's no MPI match. It's just the money that's in your policy that they want you to pull out and put it back in. It's your money matching your other money. It's not MPI boosting your account with any extra funds. So I think it's a little misleading. in that regard. But if you read through the materials, which I did on one of them, it pretty clearly spelled out that the money is the money in your policy, the cash value available in your policy that you're borrowing out and putting it back into the policy. Now they like to, in their design, they say, pay a couple of years and then start pulling it out. And, they'll expand the policy a couple of years down the road, and then you'll be able to pull out cash and put it back in at that point. There's no reason you can't do that from day one. I don't know why you have to wait a couple years. I think the only reason I can think that they would maybe want you to wait a couple of years is because it builds up cash value into your account, and it's less likely to encounter problems if the index doesn't perform how you would hope it would perform. And because they don't talk a whole lot about that possibility happening, it's probably easier for them to just sell it as put the money in and take the next steps a couple years down the road. So that's the feeling I got from it. That's the feeling I got from it. Top Gun. MPI is simply taking advantage, leveraging permanent insurance to buy more insurance. Nothing radical here. You can find banks that will give you a line of credit against your insurance policy at a good interest rate. Ding, 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 ding. Yep, that's exactly right. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.